The U. Debt ceiling is a legal limit on how much the federal government can borrow to pay its bills. If Congress does not raise the debt ceiling by October 18, the Treasury Department will run out of cash and may default on its obligations, triggering a global financial crisis. Asian currencies and markets are closely watching the developments in Washington, as a U. Default could have severe consequences for the region. Asia is a major holder of U. Treasuries, which are considered the safest and most liquid assets in the world. A default could erode the value and confidence in these securities, causing capital flight and higher borrowing costs for Asian governments and businesses. Moreover, Asia is highly dependent on trade with the U, which is the largest export market for many countries in the region. Default could also trigger a recession in the world's largest economy, reducing the demand for Asian goods and services. This could hurt the growth prospects and current account balances of Asian countries, putting downward pressure on their currencies. Some Asian currencies are more vulnerable than others to the U. Debt ceiling standoff, depending on their exposure to U. Dollar debt and trade. According to a report by Moody's Investor Service, the most exposed countries are Malaysia, Indonesia, Thailand, and Vietnam, which have high levels of external debt denominated in U. Dollars and large trade surpluses with the U. These countries could face currency depreciation, capital outflows and inflationary pressures if the U. defaults. On the other hand, some Asian currencies could benefit from a safe haven demand if the U. debt ceiling crisis escalates. These include the Japanese yen, the Chinese yuan and the Singapore dollar, which are seen as more stable and resilient in times of market turmoil. These currencies could appreciate against the U. dollar and other riskier assets, providing a buffer for their economies. So far, Asian currencies have been consolidating against the U. dollar in anticipation of a resolution to the U. debt ceiling impasse. However, if the talks fail and the deadline approaches, volatility and uncertainty could increase in the currency markets, affecting both Asian economies and investors. The factors that could support or weaken Asian currencies in the near term, such as economic data, geopolitical tensions, commodity prices and COVID-19 developments. Asian currencies have been consolidating ahead of the U. debt ceiling talks, which could have a significant impact on the global financial markets and the U. dollar. The U. Congress has until mid-October to raise the debt limit or risk a default on its obligations, which could trigger a sharp sell-off in U. Treasuries and a spike in borrowing costs. This would also weigh on the U. economic recovery in the Fed's tapering plans, which could lead to a weaker U. dollar and a stronger demand for Asian assets. However, there are also other factors that could support or weaken Asian currencies in the near term, such as economic data, geopolitical tensions, commodity prices and COVID-19 developments. Let's take a look at some of them. Economic data. Asian economies have been showing signs of resilience amid the pandemic, with China leading the way with robust growth and exports. However, some countries are facing headwinds from supply chain disruptions, labor shortages and rising inflation. Investors will be closely watching the upcoming data releases from China and the U. such as GDP, industrial production, retail sales and consumer confidence, to gauge the strength of the two largest economies and their implications for Asian currencies. Geopolitical tensions. The geopolitical landscape in Asia remains tense, with ongoing disputes over Taiwan, Hong Kong, the South China Sea and North Korea. Any escalation of these conflicts could dampen investor sentiment and increase demand for safe haven currencies such as the Japanese yen and the Swiss franc. On the other hand, any improvement in relations between the U. and China could boost confidence and support riskier currencies such as the Australian dollar and the New Zealand dollar. Commodity prices. Commodity prices have been rising due to strong demand and supply constraints, which could benefit some Asian exporters such as Australia, Indonesia and Malaysia. Higher commodity prices could also fuel inflationary pressures and prompt some central banks to tighten monetary policy, which could strengthen their currencies. However, higher commodity prices could also hurt some Asian importers such as India, Thailand, and the Philippines, who have to pay more for their energy and raw material needs. COVID-19 developments. The COVID-19 situation in Asia remains uncertain, with some countries struggling to contain new outbreaks and variants while others are making progress in vaccination and reopening. The pace of recovery in Asia will depend largely on how well each country can manage the health crisis and balance between saving lives and livelihoods. A faster vaccination rollout and a lower infection rate could boost consumer confidence and spending, which could support domestic demand and currency appreciation. Conversely, a slower vaccination rollout and a higher infection rate could undermine consumer confidence and spending, which could hurt domestic demand and currency depreciation.